All right, good afternoon and welcome everyone to the Trading Talk, the Uncensored live Q&A session. My name is Danny and I will give you the webinar today. We're gonna, as I said, we're gonna open the webinar with the questions that we see in here. We're gonna take each question and paste it in our notepad for us to put to write the answers. So as we can see, the first question is, by the way, before we begin, I would like to say that the interface we're using today will be the web trader. To access the web trader, all we have to do is just to log in with your email and password. You do not need to install or download anything. You need to click on web trader or web trading and you're supposed to be right here. Okay, the first question is, let's see, is there any way to split the margin to different accounts for different strategies? Yeah, this could be, basically this could very easily be done by we can create a sub account under the same email via our personal area. Okay, the way that it works is sub account, as an example, of course, sub account A will be, let's say, number, okay, 1, 2, 3, 4, 5 will be, let's say, commodities. Okay, I don't know, gold, silver, whatever you want, platinum, wheat, any other commodities that you want. Let's say balance, maybe 5,000, let's say, okay. Sub account, this is everything under the same email. I don't have to open another account and register again. I just create a sub account, which is a different number as we see in here, and I can just log into it separately with a different balance to a different strategy. This way, I'm gonna write down, let's say, this is my other account. Of course, it's a fictional number. I just made it up at a moment just to show you you know, this example, and this will be, let's say, let's make it swing. Okay, we don't really swing with $5,000, but again, just bear with me for the sake of the discussion. It's not okay. And in here, let's say intraday. Okay, intraday like this. And in here, it will be, I don't know, stocks. It should have been the other way around. I mean, that's what's common, but again, it's not anything specific. It's just to show you here, guys, an idea, right? So in this case, and let's say that in here, we're gonna have a balance of, let's say, another $5,000. Okay. And I can carry on and list down more and more accounts that's similarly with the same. This could be something else, by the way. This also could be if those are, let's suppose that this is CFDs, right? CFDs sub account. So I could also, if I would want, as an example, I could have also option account. Okay, so this will be another 5,000. And I can have another maybe futures account. And anyway, you guys, you got the idea. What I can do is I can split a certain amount to different accounts. This sometimes keeps me more organized. This way I know exactly how much margin I've got available, how much margin I'm using in this specific strategy. So as I was explaining about the different sub accounts that we can have is, as you can see, what's displayed in here is basically different accounts with different amounts and different strategies. Again, the reason for me to want to do that is to be able to syndicate a specific amount to each strategy. Of course, I could just as much have 10,000 and trade everything on the same account, but then I'll have to think how to divide my margin and how I can keep maintaining my margin with the various instruments. So of course I can do that. Both options are great. By the way, I'm not going to tell you if to split your margin or not, but to answer the question here, is there any way to split the margin to different accounts for different strategies? This is a very nice way that this can be done. Okay, so I'm going to take the answer here. We're going to paste it right under the here. If hopefully, there we are. Okay. And the the second question is, maybe we'll add the examples as well. I'm not sure we have enough space for that, but let's see. Okay. Now the maybe I'll make it a bit smaller. This way it occupies. There we go. The second question is, if I trade more instruments, will I make more profits? Oh, okay. So the question is, if I trade more instruments, will I make more profits? The answer is, more instruments doesn't give you more profits or more losses. It gives you the ability to diversify. Meaning, for instance, let's say that I trade Aussie versus Canadian dollar. Okay, I have one position with Aussie Canadian dollar, and let's suppose that I'm trading one lot like that. And let's suppose also we're not going to do any crazy analysis. We're just going to make this one 9, and we'll make this one 7. So this is 100 pips less. Sorry, 1,000 pips less. And as we can see in here, this is what we can make or lose. So this is the possible profit and possible loss. This is only for this position, Aussie Canadian dollar. Of course, this is not a proper risk money management or anything like that. This is really just numbers that I've placed, nothing calculated. But if we look in here and understand the question, more profits, does that mean more instrument? Does this means more profits? The answer is no. If, for instance, I take the position like this with Aussie, and I let's maybe add another one. Yeah, let's say oil. Okay, we have one position with the Aussie Canadian dollar and one position with oil. As we can see, the potential profit and loss here is 7.3 and 7.31 maybe. Okay, the margin, so-called cost margin requirement for this position is $3,200. And now if we click on oil, click on buy. Again, there is no analysis that I'm doing right now, just to help to understand that a bit better. Same in here. So we're gonna take maybe some ambitious price, again, just to help understand this a bit. Okay, and again, we are let's say we'll switch this one to weeks. Okay, yeah, and even though those are imaginary number, let's maybe cut it down just a little bit. So we'll make it 68, and we'll make that 58. Okay, 0.2. Now, even though I've added another instrument, and the way that I'm simulating, by the way, is with take profit and stop loss. Take profit allows me to close the position automatically with a profit. Stop loss basically allows me to close the position automatically with a loss. This way we can simulate and see the possible profit and loss. Now, if we'll examine the specs of what we seeing here and what we saw with the Aussie Canadian dollar, it's true that if I'll take this position and the position that we saw with the Aussie Canadian dollar, if I make profits on both, I make more profits. But it's not because I've traded more instruments, is because I took another position. Okay, so I could maybe take two positions with Aussie Canadian, and I would I would also make more profits. So what does it give this? What's the advantage basically trading another instrument? To diversify. If Aussie Canadian dollar doesn't go as I plan, okay, let's write it down. Okay, so we've got the take profit and stop loss. We said that could either make us 7,300. That was one lot. That was also a buy. Okay. So this, what we could have make, right, or lose. This is one position, and we said, oh sorry, and we said another position with oil. Same thing, buy, also one lot. Miraculously, the margin requirement of 3.3 and 6.3 is bringing us almost to the max of our margin, 9.9, when we are with 10, yeah. But again, we're not there. We're not, this comparison is not to teach you analysis or anything like that, just to understand the question. Oh, sorry, this one is 5,000. Now, what are we getting from what are we getting here? What are we trying to get here? Diversification. Diversification, not more profits or more loss, simply the ability to compensate one position with another if one goes well and the other one doesn't go well. If I'll only trade Aussie Canadian dollar and my positions are with a buy and I do not make profits, then I just lose. If I have a position with a buy with Aussie and one position with oil, and then one position make profits and one position does not, then I can maybe balance myself with the other position. Okay, it seems like the issue that we have with the screen just keeps happening. Let's hope it doesn't happen again. Okay, it does, never mind. Just a second. Okay, so as I was saying, what we can get from trading two different instruments is obviously diversification. Now, the size of diversification that we would like to have, let's suppose that instead of trading only Aussie Canadian dollar and oil, we will have another, I don't know, gold and maybe some other, maybe some I don't know, some other commodities, coffee and palladium and whatever you like. I also need to remember in this case that the margin impact is also something that I need to be aware of, because the margin impact, the margin level, is something we always want to maintain in a proper level. Okay, and as long as we're doing that, and as long as we do the proper risk money management, diversification can be helpful. Okay, so to answer the question in here, it will be a no. It will be no more instruments does not necessarily does not mean necessarily more profits or more loss.